Let's go ahead and start talking about the consolidation process. We'll start with the simplest example, the consolidation of a wholly owned subsidiary acquired at book value, and we'll start with the consolidation as of the date of acquisition. Now, let's go ahead and assume that Big Company acquires 100% of the voting stock of Little Company on January 1st, 01 for $300,000 cash. On that date, Little Company had a book value, that is their net assets or their owner's equity, that we'll use those terms synonymously, of $300,000, and that all of their assets and liabilities had fair values equal to book value. And let's go ahead and assume that on the date of acquisition, Big and Little have trial balances as given in the following worksheet. And basically, this is what's referred to as a 5-column worksheet. It's actually 6 columns if you include the account titles. But basically, we've taken the trial balances for Big and Little and simply listed them vertically. Assets first, liabilities and equity on the bottom half. Things to note here, we have on Big's trial balance, we have their $300,000 investment in Little. In Little's column, we see that their owner's equity, common stock and retained earnings, totals up to $300,000. And of course, that is also equal to their total assets minus their total liabilities. Now, we want to present Big and Little as a single consolidated economic entity. The consolidated financial statements should be almost indistinguishable from those that would be prepared if this was a merger. And recall what we did in the case of a merger. Basically, if Big had acquired Little in a transaction to be accounted for as a merger, Big would simply absorb all of Little's assets and liabilities. Little's former shareholders would no longer be shareholders. They wouldn't be represented on Big Company's balance sheet. Again, Big would simply absorb or assimilate all of Little's assets and liabilities. There would be no investment in Little account. Again, in the case of a merger, we simply absorb their assets and liabilities. We don't have, in addition, an investment account. Similarly, or additionally, since we're presenting Big and Little as a single combined entity, it would be sort of nonsensical to have an account on our balance sheet called investment in ourselves, which is essentially what that would amount to. Again, Big and Little are going to be presented as a single combined entity. You can't have as an asset an investment in part of yourself. Similarly, Little's equity accounts have to be eliminated. And again, we can look at this in two ways. First, from the merger analogy, if this had been a merger, the only equity accounts would be those of Big. Secondly, thinking of Big and Little as a combined economic entity, the only external economic agents who have a claim on this combined entity are the Big Company shareholders. The Big Company shareholders have their equity claim, which by extension represents a claim on the ownership of Little. So we're going to be making a great deal of use of what are referred to as elimination entries. Now, these are worksheet entries. They are not actually recorded on the books of either company. They're simply a means for us to organize our work. And the first of these entries is what I refer to as the S entry for start, at the beginning of the process, or subsidiary equity if you prefer. And in this entry, again, we're going to eliminate the subsidiary's owner's equity accounts. So we're going to go ahead and debit to eliminate the subsidiary's common stock account. Common stock is a credit balance, so to eliminate it, we will debit common stock. We're going to eliminate their retained earnings as well. Again, retained earnings is a credit balance, so to eliminate it, we're going to debit retained earnings. And then third, we're going to go ahead and eliminate the parent's investment in Little. The investment in Little is an asset with a debit balance, so to eliminate it, we will credit that account. Obviously, debits must equal credits, so in this nice elimination entry, we have $300,000 on the debit side, $300,000 on the credit side. Now, as we'll discuss later in much greater detail, These elimination entries can be prepared in any of a number of fashions. Now again, this is a very simple example. We've only got the one entry. As we get to more complex examples, we might have as many as 5, 6, 7, 8, 9, 10, or 10 or more things we need to adjust for or eliminate. Now, how those elimination entries are organized and summarized will differ depending upon who's doing the work. I have a process which I follow, which I think is very intuitively appealing and makes a lot of sense. The textbook authors use a different process. Both processes get you to the same result. Again, I have a strong personal preference for the way I do it, obviously. We'll talk, though, in the future about how to sort of reconcile or confirm that what we're going to be doing matches up against what the textbook authors do. Okay, in any event, once we prepare this elimination entry, we now start posting this to the debit and credit columns of the worksheet. So first, again, looking at this S entry line by line, we have a $100,000 debit to common stock. So down there near the bottom of the worksheet, we put $100,000 in the debit column on the common stock row. And I like to put a little S in parentheses by that to indicate that this $100,000 debit came from the S entry. And again, in this case, obviously, it's sort of trivial to do that. As we get to more complex examples where we're going to have multiple elimination entries, it might be very handy to know where each of the entries in the worksheet came from. Next, we continue by debiting $200,000 to the retained earnings account in the worksheet. And then third and finally, we credit the investment in little for $300,000. Again, the hard part of this process is doing the elimination entries. Once you get the elimination entries, the rest of this is simply mechanical. All we're doing is transcribing that S entry from a journal entry format to the worksheet. Debits to the debit column, credits to the credit column. As a final step before we go any further, it's really a good idea to go ahead and tally up the totals for the debit and the credit columns, just to be sure that your debits continue to equal your credits. So total debits in the elimination entry debit column are $300,000, total credits $300,000. Now we start finishing up our worksheet and getting our consolidated totals. And at this stage, again, this is a very mechanical process. We're going to add across each row of the worksheet, keeping in mind the appropriate debit and credit rules. So cash, $30,000 for big, $10,000 for little, no eliminations or adjustments, so we simply add them together, $40,000. Likewise for our receivables, $50,000 for big plus $30,000 for little, with no eliminations or adjustments, total $80,000. Inventory, same drill, $60,000 for big plus $40,000 for little, total of $100,000. Now we get to the investment in little. And again, big's investment in little is a debit balance. That's being offset or countered or wiped out, whatever term you want to use, by the $300,000 credit in the elimination column. So a $300,000 debit offset by a $300,000 credit nets out to zero. And that's a check figure which we can rely on in all cases. The investment in little has to go to zero. If you add across that investment in little account row and it doesn't equal zero, then you've made a mistake somewhere. Continuing with this, property, plant, and equipment net, $300,000 plus $240,000 with no adjustments, total $540,000, and continuing on all the other accounts in the same fashion. Intangible assets totaling $200,000. Jumping down to the liability side, current liabilities, $30,000 plus $20,000 is $50,000. Bonds payable, $200,000 plus $100,000 is $300,000. And now for our equity accounts, again, we add across keeping in mind the debit and credit rules. Common stock as reported, $150,000 for big, $100,000 for little, total $250,000. But we have a $100,000 debit in the eliminations column, and again, a debit in the equity section is a negative, so basically we're netting out or eliminating the subsidiaries. We're netting out or eliminating Little's common stock account, so we're left with Big's common stock of 150. And the same thing for retained earnings. Again, we have 460,000 for Big. Little's retained earnings of $200,000 is being offset or negated or wiped out by that $200,000 debit in the elimination column.